The 1987 stock market crash. Envision waking up on a Monday and within hours seeing trillions of dollars vanish like smoke. Stock markets worldwide in freefall, phones ringing incessantly, operators screaming, companies descending into chaos. All of this unfolding on a single day. What could have caused the largest percentage drop in American stock market history in a single day? Sabotage, a system error, or simply fear spreading faster than any algorithm? October 19, 1987, etched itself into history as Black Monday. On that fateful day, the Dow Jones index plummeted nearly 23%. To put that into perspective, it surpassed the devastation witnessed on the worst day of the 1929 crisis. Investors who considered themselves untouchable found their fortunes evaporated overnight. The most perplexing aspect? The American economy wasn't teetering on the brink of collapse. There were no wars, pandemics, or obvious economic bubbles. So, what triggered this global cataclysm? Behind the chaos, a new player entered the game: automated trading systems known as program trading. They were designed to safeguard investors, but ended up exacerbating the panic. Could this be the first indication that machines could trigger even more catastrophic collapses in the future? As auction houses became battlegrounds of emotional turmoil, with nations like the United Kingdom, Japan, and Australia succumbing to a domino effect of plummeting markets. Images of traders ripping out their hair and analysts flabbergasted spread globally. Was this the demise of capitalism as we knew it? However, this tale harbors astonishing twists. What seemed the dawn of a new Great Depression culminated in an unexpected denouement. But to understand how it all began and why the 1987 crash still haunts the back rooms of Wall Street to this day, we must journey back in time, exploring the political climate, the ignored warnings, and the blunders committed by both men and machines. Brace yourself for a journey into the heart of the 1980s financial market, a world where avarice, technological innovation, and fear coalesced to create a perfect storm. The year was 1987. The United States economy appeared robust. Inflation was under control, unemployment was declining, and optimism permeated Wall Street. It was the zenith of the Reagan era. Deregulation of markets, tax cuts, soaring consumer spending, and an almost blind faith in the invisible hand of the free market. The Dow Jones surged dramatically. In the first half of the year alone, it had already amassed over 40% in value. But, like any silent bubble, signs that something was amiss began to emerge, though largely ignored by many. The stock market was soaring at an unsustainable pace, with no clear underpinning in the real economy. Companies were not generating profits commensurate with the surge in their share prices. A few analysts started to sound the alarm, but their voices were drowned out by the prevailing euphoria. In the background, two tensions were quietly mounting: the increasing interest rates in the U.S. and a growing concern over the twin deficits, the fiscal and the trade deficit. Since the Plaza Accords in 1985, the dollar had been losing ground, and the U.S.'s allied nations were pressing for currency adjustments. This led to a growing wariness among investors. Meanwhile, a novel technology was emerging in the shadows of Wall Street: program trading systems. These operated on the basis of algorithms that automatically executed buy or sell orders, eliminating the need for human intervention. One such mechanism was known as portfolio insurance, which purported to safeguard large portfolios against sudden declines. The principle was straightforward. If the market began to fall, the systems would automatically sell to mitigate losses. But what would happen if thousands of systems began to sell simultaneously? The week prior to the crash, the market was already displaying signs of instability. On Wednesday, October 14th, the Dow Jones plunged by over 3%. On Friday the 16th, the decline was even more pronounced, a staggering 4.6%. Investors began withdrawing their funds, and anxiety intensified with every passing minute. Over the weekend, newspapers blazed with alarming headlines, and rumors of an impending catastrophe spread like wildfire. And so, Monday morning, October 19, 1987, dawned. Sell orders began cascading even before the market opened. When the trading floors commenced, prices plummeted. Each transaction fueled further panic, perpetuating the cycle. Automated systems, perceiving the price decline, triggered even more sell orders, a chain reaction spiraling out of control. Operators watched helplessly as billions in market value evaporated. Many were unable to even input their orders swiftly enough. What was unfolding was not a rational movement. It was pure fear, amplified by machines that did not know what panic was, only that they had to follow instructions. The market was self-destructing in real time as the world watched in stunned silence. But this was just the beginning. Behind the scenes, financial leaders would need to act swiftly to prevent the collapse from spiraling into a catastrophic crisis, and the unfolding events in the days to come would leave everyone astonished. The world watched in stunned disbelief as financial markets teetered on the brink of collapse. On October 19, 1987, the Dow Jones Industrial Average plummeted an astonishing 22.6%, the largest single-day percentage decline in the history of the American stock market. To put this into perspective, such a drop would equate to losing over 7,000 points in a single day at the current index levels. The disruption was global. The London Stock Exchange plummeted by 11%. Hong Kong's market collapsed by over 45% in just a few days, and similar catastrophes unfolded in the markets of Australia, Canada, Germany, and Japan. The domino effect was palpable, demonstrating that panic knew no boundaries. Confidence in the stability of the global financial system had been profoundly shaken, all within a matter of hours. However, what most astonished analysts was the fact that the crisis lacked a clear or isolated economic cause. There was no collapse of major banks, nor a specific asset bubble that burst. Instead, the crash was exacerbated by a perilous confluence: distorted expectations, leveraged operations, and automated selling algorithms that, rather than providing safeguards, proved devastating. Behind the scenes, the Federal Reserve, helmed by the newly installed president, Alan Greenspan, responded with alacrity. Rather than seeking immediate scapegoats, the Fed issued a landmark statement. The Federal Reserve, in keeping with its mandate as a source of liquidity, stands ready to provide liquidity to the financial system to support the nation's economic and financial operations. With that single statement, the central bank signaled to the market that it was prepared to inject liquidity and ensure the continued operation of financial institutions. Confidence began to slowly reemerge. In the ensuing days, the market fluctuated but avoided a complete meltdown. And, defying the most pessimistic forecasts, there was no recession in 1988. In fact, the market commenced its recovery just months later. But the reverberations of the 1987 crash were profound and enduring. The event served as a stark warning about the perils of ill-understood technology in financial markets, the role of algorithms in herd behavior, and the capacity of automated decisions to amplify human fear rather than mitigate it. Furthermore, the panic of 1987 compelled regulators to reevaluate the functioning of stock exchanges. A mechanism, now commonplace in major global exchanges, was established: circuit breakers, temporary suspensions of trading when declines exceed certain thresholds. The aim is to provide the market with a moment to stabilize, allow investors to regain composure, and prevent panic from escalating into a frenzied mass psychosis. Despite the subsequent technical recovery, many investors never viewed the market in the same light again. The 1987 crash served as a subtle watershed moment. It did not precipitate a direct economic crisis like 1929 or 2008, but it exposed a structural vulnerability inherent in the modern financial system: its fragility in the face of the technological and emotional interconnectedness of markets. And, over 3 decades later, the specters of that fateful Monday still haunt the algorithms that today govern even vaster sums of money at infinitely faster speeds. What can we glean from the 1987 stock market crash more than 3 decades later? That the global financial system, for all its perceived robustness, can be destabilized by a cascade of poorly coordinated decisions, human emotions, and automated codes that fail to distinguish panic from rational thought. Black Monday was more than just a numerical decline. It was a reflection of what transpires when confidence, the true engine of the economy, is abruptly shattered. In 1987, we were witnessing the nascent stages of automation in the markets. Algorithms were still in their infancy, and investors placed excessive faith in their purported protective capabilities. Today, with artificial intelligence managing trillions of dollars in assets, what would transpire if an error or even a collective behavioral anomaly triggered new waves of automated selling? Where once the shouts of traders heralded chaos, today it would take a single, invisible glitch to cripple markets in seconds. The crash of 1987 remains relevant because it exposed a fundamental truth. Technology can amplify both the efficiency and the fragility of systems. The very mechanism that safeguards an investor, when extrapolated, can lead millions to ruin if it is neither understood nor regulated. But there's another, more profoundly human aspect: collective psychology. The euphoria preceding the crash, the denial of warning signs, the overwhelming fear, all of it repeats itself decade after decade, albeit in different guises. 1929, 1987, 2000, 2008, emotional patterns reemerge because, despite all our progress, humanity remains driven by greed and fear. And despite our attempts to blame computers, banks, or politicians, the truth is that the 1987 crash was a reflection of our own illusion of control. We believed we could predict everything, safeguard our fortunes with mathematical formulas. But we forgot that the market is composed of people, and that no machine can contain the collective panic when it spreads like wildfire through tinder. The crash did not plunge the world into recession, but it sounded an alarm that many chose to disregard. To this day, there are those who view the market as a modern casino, gambling based on fleeting trends and relinquishing control to algorithms. But have we truly learned our lesson? If you've made it this far, perhaps this story has prompted you to think differently. And that's the mission of Enriching World, to tell stories that not only inform, but also spark reflection, inquiry, and learning. Now we want to know, were you familiar with the 1987 crash? Do you believe a collapse of that magnitude could occur again today? Leave your comment, share your insights and experiences. Like this video if it helped you see the market in a new light. Subscribe to the Enriching World channel and turn on notifications so you don't miss the next episodes. And if you want to continue this journey, watch now our video about the 2008 collapse, where other, equally human errors almost destroyed the global financial system once again. For understanding the past is the most effective way to safeguard oneself in the future.